Welcome back to the deep dive. If you've ever used a digital wallet or, one of those zero-fee stock trading apps, you've probably asked yourself the big question.
How do they actually make any money?
Exactly. How does a fintech company survive when their core services seem so cheap or sometimes even completely free?
It's a great question because it really feels like an illusion, doesn't it? On the surface, it's all about speed and low cost.
Right.
But the long-term viability, that's not built on just the transaction. It's built on these intricate, often invisible revenue mechanisms happening in the background.
And that's our mission for this deep dive,
Mhm.
to really unpack the global strategies that let these companies scale and, well, survive.
Mm-hmm.
We want to show you that it's not about one secret hack, but more about mastering four pillars: digital distribution, data-driven decisions, super low operating costs, and of course, tech-enabled service delivery.
And we really have to look globally. I think that's key. These models are not one size fits all.
Not at all.
What works in Asia with super apps and massive populations is just radically different from what we see in the US or the UK, which are shaped by, existing banks and heavy regulation.
So let's start where the margins are probably the thinnest.
Yeah.
India,
Do
the
that.
pressure to innovate there is just immense. FinTechs face smaller financial margins and customers who are extremely sensitive to price.
It forces a completely different way of thinking. What's fascinating about India is that it really operates on a volume-based revenue model.
Volume.
Yeah, because the direct revenue from a tiny payment is almost nothing. You can't really monetize a 1 rupee transaction.
Right.
So Indian fintechs have to rely on getting to a critical mass and then leveraging really intensive partnerships. Payments are basically just the cost of customer acquisition.
So a company like PhonePe or Paytm, they're not really profiting from just moving my money around
Not directly, no.
Yeah.
They're using that platform as a gateway.
to sell other things.
Exactly. They monetize through value-added services.
Ah.
Things like insurance distribution, wealth products, tools for merchants, and especially lending.
Lending.
They use embedded finance, co-lending arrangements. They partner with the regulated banks who handle the capital and the regulatory burden, and then they just take a slice, a revenue share.
But wait, if they're relying on co-lending and sharing revenue, doesn't that squeeze their margins even more? And they don't fully own the customer data, right?
It does. It's a trade-off. It requires super
I
tight
know.
execution. But they mitigate that risk by leveraging India's, its unique public digital infrastructure.
The payment and identity systems.
Precisely.
Yeah.
That infrastructure just dramatically slashes the cost of onboarding a new customer, of doing compliance checks. So they sacrifice that vertical ownership for speed and scale.
They're betting that sheer volume will make up for the thin margins.
That's the bet.
Okay, so that partnership approach is a really interesting counterpoint to our next region, China, the global master of the integrated digital ecosystem. Where India partners, China seems to demand total control.
It's all about ecosystem ownership there. The super app model, Alipay, WeChat Pay, that's the blueprint for the world. They start with a simple payment utility to get everyone on board.
And then build a whole digital city on top of it.
That's a great way to put it. They move the user seamlessly from paying for a coffee to getting a microloan to buying an investment product, all in one app.
And that multi-layered structure, that's what's driving the actual profit.
Absolutely. Their revenue streams are so much more comprehensive. They're earning merchant fees, sure, but they're also generating huge income from credit underwriting spreads. They're taking fees for distributing wealth products, and they're earning insurance premiums.
And technologically, they're using all that data they own for incredible efficiency.
Look at a digital bank like WeBank. Their income comes from microloans, but the risk assessment is entirely AI-driven.
So no loan officers.
No. They can approve millions of loans almost instantly while keeping their operational costs, one of our core pillars, so much lower than a traditional lender.
So both India and China prioritize minimizing costs through tech. But China does it through owning everything, and India does it through partnerships and public infrastructure.
That's the key takeaway. Two different paths to the same goal.
Let's pivot now to the Western markets. Regulations, established banks. It forces a very different kind of adaptation, starting with the U.S.
The U.S. market is much more about specialization and highly diversified income streams.
Okay, so what does that look like in practice?
Well, take digital banks like Chime. Their main source of revenue is something called interchange fees.
Right, the little fee the merchant's bank pays every time I swipe my debit card.
Exactly. Chime gets a slice of that. They also bring in money from regulatory partnerships with established banks, which is key for them to scale and stay compliant.
And what about the investment platforms? Like Robinhood offering commission-free trading, that still feels like magic to me.
That magic has a name. It's called payment for order flow.
PFOF.
PFOF, yeah. Basically, they get paid by big market makers to route their customers' trades to them. It's a bit opaque, maybe, but it's what subsidizes that free trading model for you.
And they have other streams too, I assume?
Oh yeah, securities lending, premium subscriptions for their most active users. The US model really depends on running these super lean, digital-only operations to make those small margins work at scale.
Okay, so let's cross the Atlantic to the UK. A market that's defined not just by fierce competition, but by really innovative regulation.
You're talking about open banking.
Open banking.
Yeah, the UK FinTechs, Monzo, Starling, Revolut, they have to be incredibly versatile. They earn interchange fees, they make money on foreign exchange spreads, but more and more they rely on revenue from premium paid accounts.
And lending.
And lending, especially targeting small and medium-sized enterprises, or SMEs.
I hear the term BUFS thrown around a lot with the successful UK players. What is that exactly?
BUS stands for Banking as a Service.
Yep.
Companies like Starling built this amazing, robust infrastructure for their own customers. Then they realized, hey, we can package this up
And sell it.
and sell their core banking capabilities,
Right.
account ledgers, payment processing as a B2B service, to other companies that want to offer financial products but don't want to become a bank.
Yeah.
That B2B revenue is incredibly stable and very profitable.
And that's all made possible really by open banking.
Absolutely. Open banking forces banks to share data securely with third parties if the customer agrees.
Right.
UK fintechs just leverage that to build better data-driven services, better credit checks, easier payment initiation. It lets them broaden their revenue streams without bloating their own operations.
Okay, let's try to pull this all together. We've seen all these regional variations, India's volume, China's ecosystem, the US with its interchange, and PFOF, the UK's regulatory advantage. But the common thread seems to be that the initial service, the payment, is often just the cost to get the customer. The real money, the engine of profit, is in lending or subscriptions or something else.
I think that's a fair summary.
So what are the universal mechanisms that really underpin all of these different successes?
If you boil it all down globally, you can see 5 core, consistent revenue models in almost every sustainable fintech. First is the basic payments model.
Just taking a tiny percentage of each transaction.
A small percentage, yeah. Merchant fees, cross-border fees, that sort of thing. That's layer 1. Second is the lending model.
Generating income from interest, origination fees.
Or revenue sharing with the partner bank, like we saw in India. Third is subscription-based services.
Paying for premium features, better investment tools, more security.
Exactly. The fourth one feels very modern.
The curated marketplace.
Yes, the marketplace or referral revenue model. This is the commission you earn for connecting your customers to third-party services. Insurance, mutual funds, travel perks. The customer trusts your interface, and you get paid for the intro.
And the fifth, which might be the most surprising, is enterprise or B2B revenue.
This one often ends up being the most profitable for mature companies.
It's kind of ironic, isn't it? The same companies that set out to disrupt the big banks end up selling their cloud infrastructure or their compliance tools back to those very banks.
It proves that scalable technology is a revenue stream in its own right. And holding all 5 of these models up globally is data.
The non-negotiable asset.
It is. Good data means better risk assessment, less fraud, smarter customer segmentation, and better pricing. Those data insights are what allow for those super efficient cost structures we talked about.
So what does this all mean for the future? It really sounds like success, no matter where you are, boils down to having diverse income streams and just obsessive cost control through technology.
That's right. And the next evolution is already happening. It's being driven by embedded finance, putting financial services inside non-financial apps.
Right.
And also by the global expansion of open finance. We're also seeing those B2B infrastructure services like cloud banking and compliance automation becoming huge revenue drivers as the traditional guys keep trying to catch up.
So, to summarize the key lesson here for you, the listener, fintech revenue is never simple. It's never just one thing. It's a really calculated, intricate balance.
It is.
Whether that's the high-volume, low-margin game in India, the total ecosystem control in China, or expertly using data and regulation in the US and UK. Long-term survival means balancing that cool innovation with, well, actual profitability.
And this raises a final important question to think about. as regulators all over the world start looking much more closely at the financial sustainability of fintechs,
especially in lending and payments.
especially there. How will this big global shift towards embedded finance challenge the fintechs who currently rely on owning that direct customer relationship, on owning that interface for all their data and their revenue? That is something for you to mull over.